Good morning, this is Brent Gregory with another in the series of the basic accounting videos, helping you to understand the basic principles of accounting. And today we're going to address in overview the issue of depreciation. So by the end of this video, hopefully you'll understand what depreciation is and have some sense of how it's calculated. Now I can imagine that you may be curious as to what depreciation actually is. So depreciation is, and this is something that you will need to understand very well, depreciation is a method for allocating the cost of an asset over its useful life. Now I may mention this to you again, but depreciation is a method for the allocating of the cost of an asset over its useful life. But before we start, let's think about some of the key principles that are related to depreciation. And understanding these principles will help you have a good appreciation of how accounting fits together. We'll look at three principles now: the period concept, the cost concept, and the matching principle. So the cost principle, this means that we record all accounting transactions at their original purchase cost. This is often referred to as historic cost. So you might hear the historic cost principle or historic cost accounting. So this is related to the cost principle and is very relevant in depreciation. The period concept defines the period for which our accounting data is collected and recorded and reported. Now typically this is going to be a year. And the matching principle really says that we need to match our expenses to the revenues that they help us produce. In other words, we match our inputs to our outputs. So this brings us back to depreciation. Depreciation is a method for allocating the cost of an asset over its useful life. And there's a few things you'll see here related to those principles. There's the cost principle, so allocating the cost of an asset over its useful life, which is about the matching principle, and the period concept. So what periods do we have and how do we match the cost to the period? So how do we treat the situation where we purchase an item that has a useful life that extends beyond the current period? I.e., we buy a motor vehicle, we think it's going to last for 5 years. Is it appropriate we record the total expense this year and count that as an expense for this year? So what must we do? Righto, firstly we must record it at its cost. So we record the cost, which is a cost principle. And now as far as expenses go, we must recognise the usage of this motor vehicle for the period for which it's useful. And this is related to the period principle and the matching principle. So let's consider three items that we do need to record: the original cost, the usage of the item in each accounting period, and this we refer to the depreciation expense, and then the total of all the usages since purchase. That's accumulated depreciation. So I will work through an example that will explain this a little bit more so that you understand what the cost is, you understand what depreciation expense is, you understand what accumulated depreciation is, and you'll also understand another term referred to as the carrying amount, sometimes also referred to as the written down value. So depreciation is the allocation of a non-current asset's cost over its useful life. Depreciation matches the cost to the revenue that it helps produce, the matching principle. So as a reminder, because this is something that you must know, depreciation, it's a method for allocating the cost of an asset over its useful life. Remember, this incorporates the cost principle, the matching principle, and the period principle. It is also important to appreciate that depreciation expense is an estimation. Many things in accounting are estimations. And so looking at depreciation, we learn a lot about other areas of accounting. So how do we estimate this cost? How do we estimate how much of the expense we allocate each year? So let's look at some things we will need to know or to estimate to do this. So we need to know the cost, and that's clear. The original cost, the historic cost. We need to estimate the value of our asset at the end of the period. We refer to this as the residual value. And from this, we calculate the depreciable amount. The depreciable amount is the cost less the residual value. And we probably need to have estimated this a little bit earlier, what is the useful life of this particular asset? And we will find that later we also need to understand the pattern of use. And this will help us determine which depreciation method we use. And we will look at this in more detail in a later video. So to make these issues more concrete, let's look at a particular example. So let's assume that you purchase an asset, in this case a motor vehicle, for $20,000. You believe it will be useful for 5 years, so it has a useful life of 5 years. And in 5 years you believe you'll be able to sell it for $5,000. So one thing you'll notice here that 2 of these 3 items are estimates. We know the actual purchase price, but we estimate how long the vehicle will last for and what it'll be worth at the end of that period. So this means that you estimate the asset will depreciate for $15,000 over the 5 years you have it. And this $15,000 we refer to as the depreciable amount. So that will be the cost over the 5 years. Well, that will be the expense over 5 years. We've got their cost, but that will be the expense. The depreciation expense over the 5 years will be $15,000. So how do we allocate this expense each year? So our original cost, how do we allocate that cost each year? And when we allocate it, that's when it becomes an expense. So what are the methods for allocating the cost? Well, we can look at 3 methods: the straight line, the units of production, and the reducing balance. Which method we choose will depend upon our pattern of use. And as I said before, we'll look at that in a later video. At the moment, let's just look at the most simple, and therefore the most commonly used, the straight line method. So the straight line method assumes that we will use the asset equally in each period, and therefore we apportion the $15,000, the depreciable amount, over the 5 years. So therefore we depreciate the item $3,000 per year for 5 years, giving us a total of $15,000. We now need to consider the term accumulated depreciation. Accumulated depreciation is what's referred to as a contra account. And it is a contra account to the asset that we're depreciating. So in this case we have accumulated depreciation motor vehicle as a contra account to accumulated depreciation. Accumulated depreciation is where you accumulate your depreciation expense for each year. So think about this. We have a depreciation expense of $3,000 in the first year. So what's our total depreciation expense we've had at the end of that first year is $3,000. So we've accumulated $3,000 depreciation. The next year we will depreciate another $3,000. So our accumulated depreciation expense, our accumulated depreciation will increase from $3,000 to $6,000. All the way through and after 5 years our accumulated depreciation will be $15,000. So let's look at this in practice and how it may look and what a contra account is and where it fits. So let's look at this contra account of accumulated depreciation, and in this case it's accumulated depreciation for motor vehicle. So in our financial statements, particularly in our balance sheet, we'll have something that looks like our vehicle at cost, $20,000, less the accumulated depreciation, $3,000. Therefore, our carrying amount is $17,000. The carrying amount is not necessarily a reflection of the value of an item. What it is a reflection of is the costs that we've not yet allocated. So before we look at this again in more detail, a reminder that depreciation is a method for allocating the cost of an asset over its useful life. So let's look at how we bring the cost of this asset to account. So we've had $3,000 depreciation expense. We debit our expense account, depreciation, debit depreciation expense $3,000, credit accumulated depreciation $3,000, and our note has been the depreciation expense for the period on the vehicle. Let's have a look at depreciation in year 2. It will be exactly the same journal entries because it's straight line. It's the same depreciation each year. Depreciation expense $3,000, accumulated depreciation $3,000. But it will look a little different in our balance sheet. We'll still have vehicle at cost $20,000, but now we will have accumulated depreciation of $6,000, giving us a carrying amount of $14,000, which is the $20,000 minus the $6,000. And I guess you can guess year 3 would be vehicle at cost $20,000 less accumulated depreciation $9,000 equals carrying amount of $11,000. Year 4 would be vehicle at cost $20,000 less accumulated depreciation $12,000 equals carrying amount of $8,000. Until we got through to year 5, which would be vehicle at cost $20,000 less accumulated depreciation $15,000, giving carrying amount $5,000. And that's what we expected to end up, because we expected that's what our residual value would be. Now let's look at this in summary. Depreciation is a method for allocating the cost of an asset over its useful life. We accumulate all of the depreciation expenses into an account called accumulated depreciation. And accumulated depreciation is a contra account to the asset. In our example, the asset account was motor vehicle. The motor vehicle account, or the asset account, is always recorded as its cost. Remember, we had cost $20,000 less accumulated depreciation equals carrying amount. And the carrying amount of the asset is the cost less the accumulated depreciation. So, in order to estimate our depreciation expense, we need to know or to estimate the following things: the original cost, the residual value, the depreciable amount, which is the cost less the residual value. We need to know the useful life, and then we need to understand the usage pattern so we can decide upon which depreciation method to use. And we've looked at the straight line method. We will look at that again, and also the units of production method, the units of production method, and the reducing balance method. By the way, before I finished, did you know that depreciation is a method for allocating the cost of an asset over its useful life? Talk with you soon.